this learning objective, we explain the difficulties associated with measuring the performance of hedge funds. There are a range of reasons why performance evaluation in the context of hedge funds is a bit different from evaluating other portfolios. In particular, we have 4 issues to consider: liquidity premium, survivorship bias, changing risk profiles, and tail event and skewness. So as we've already discussed, one of the key differences between hedge funds and other investment vehicles such as managed funds is that they tend to hold more illiquid assets. Therefore, the typical positive alpha that is generated by hedge funds may potentially be interpreted as a liquidity premium. Now, because when we evaluate performance, we try to evaluate risk-adjusted performance, we might potentially need to also adjust for liquidity, given liquidity is also a risk factor that these hedge funds are exposing themselves to. So as an example of the relationship between hedge fund performance and liquidity, on the slide here we can see some historic data in terms of the average excess return that's generated by hedge funds, and on this axis the liquidity beta of that hedge fund. So liquidity beta is a measure of the degree of exposure to liquidity risk. And we can see that if we plot the values for all these hedge funds through time, we can see that there is a pretty clear positive relationship between exposure to liquidity risk and returns. So this is giving us an indication that hedge funds' returns are actually partly explained by liquidity risk, and this is one big reason why it can be difficult in providing an accurate evaluation of the performance of hedge funds on a risk-adjusted basis. Second problem is backfill bias. As we've already discussed, hedge funds do not disclose as much information compared with other investment vehicles, and often their disclosures are voluntary. What this will mean is that hedge funds' returns will only be reported to database publishers in the event that they do well. So what you find is that there's a backfill bias, so the hedge funds will only report historic returns for periods where they've done well, and a survivorship bias in that we'll only have the performance of those hedge funds that have succeeded and continue to exist, whereby we won't have any data for those hedge funds that no longer exist, and often they're the funds that were unsuccessful or performed poorly. So backfill bias and survivorship bias will create an upward bias in terms of estimating the performance of aggregate hedge funds compared with other investment vehicles. Finally, hedge funds are designed to be opportunistic. They have quite exotic investment strategies, and they have mandates that allow them considerable flexibility to change the profile of their investments across time. In a nutshell, what this means is that the risk of hedge fund investments are not constant through time. In fact, risk profiles can vary quite dramatically. Now, we know from portfolio evaluation that traditional measures of portfolio evaluation assume that risk is constant across the period that we evaluate, and those measures can't be used where we do have dynamic risk exposures. So this variation in risk that we see across time means that many of the traditional portfolio evaluation techniques are not valid to measure the performance of hedge funds. Last of all, we've spoken previously about the fact that hedge funds tend to invest in assets that have a negatively skewed return distribution. This means that hedge funds will actually be exposed to losses associated with tail events, and those tail events may not be observable ahead of time, so we might not properly include the risk of tail events in our risk assessment when calculating risk-adjusted returns of hedge funds. Some examples of tail events include things like the October 1987 stock market crash and the global financial crisis, but most particularly we can think of long-term capital management, which was a hedge fund set up to try to profit from the liquidity differences between the most recently issued and previously issued government bonds, known as on-the-run and off-the-run bonds. And in this particular case, because of a Russian government default on debt and the spillover effects that this had on international economies, including the US economy, there was huge negative losses that were generated on this investment strategy that arguably could not be foreseen in advance. And therefore, if you were trying to evaluate the risk-adjusted performance of LTCM before this event, you would say that they're performing very well because the risk profile looks such that they had a very low level of risk. but that was only because we couldn't observe the probability of this tail event occurring, and when this particular event did occur, it forced LTCM out of business. So it was quite a significant event that brought this hedge fund to its knees. So the risk associated with negative skew and trying to predict tail events and the probability of tail events are another reason why hedge fund performance is difficult to assess. So taken together, there's a lot of evidence that shows that it is quite difficult to evaluate the performance of hedge funds. Hence, it's difficult for us to really know whether hedge funds perform more favourably or less favourably compared to other more conventional types of funds such as managed funds.